Are you tired of paying taxes? Yeah, me too. Taxes stink. But I recently heard that some people pay very little in taxes. In fact, the president tax returns showed that he paid $750 in federal income taxes in 2016 and 2017, and nearly nothing years before that, according to reports from the New York Times. And that sounds too good to be true. So I decided to take a deeper look and to share how you could also pay very little in taxes with real estate. I'm gonna walk you through exactly what I found and share a real scenario with you. Stay tuned. Hey, I'm Sean with Life Accounting, the accounting firm that saves people from high taxes and low profits. Today we're gonna take a look at how you can pay very little in taxes with real estate legally. Now, we just did a video about the new tax brackets going into 2021, which I'll link up above. But it's important that you first understand how the tax system works. So by the end of this video, I expect you will know a lot more about the tax system and what you can do to start paying less taxes with real estate. But before I dive in, if you love business, you love growth, please consider subscribing to our channel to get more accounting hacks. Also, thank you to everyone who's been subscribing and leaving positive feedback in the comment section. Your comments really motivate us to continue making videos and to produce valuable content. And of course, disclaimer here, this is not financial advice, and we always recommend that you speak to your accountant or your lawyer for specific advice and recommendations for you. All right, now that that's out the way, let's go ahead and dive in by talking about how the tax system works. And to do this very easily, we're gonna use a fictional character throughout this video, which we're gonna name Bob. And let's say that Bob is a fictional corporate executive that earns $100,000 a year and is currently single. And Bob wants to make smart investments with his money so that he can retire comfortably. Okay, so let's look at Bob's tax situation. I'm gonna put up on the screen the planned federal tax brackets for 2021. Now, can you guess which tax bracket that Bob is currently in? Is it A, 24%, B, 22%, C, 32%, or D, none of the above? If you said none of the above, then you're right. You see, even though Bob's 100K salary fits into the 24% tax bracket, his federal taxes won't be $24,000. Because being in a tax bracket doesn't mean that you will pay that federal income tax rate on everything that you make. The progressive tax system means that people with higher incomes are subject to those higher rates, and people with lower taxable incomes are subject to lower federal income tax rates. And this is what helps make the tax system fair. So Bob's federal taxes will look more like this. You can pause the video right here if you really want to understand the math. I've expanded the tax brackets from earlier so you can see how some of the math is calculated. As you can see, even though Bob's income is at $100,000 and he makes it to the 24% tax bracket, he is only taxed $13,625 at the 24% tax bracket rate and actually pays lower taxes in the 24% tax bracket than he would at the 12% tax bracket. And this is very important to understand because you want to understand the tax laws and the tax system so you can use that to your advantage. You have to know how the game is played so you can maximize your chances of winning. Hey Sean, look, I can make more points shooting layups than I can shooting half-court shots. And that's true, right? If you know the game, then you increase your chances of dominating the game. In other words, if you're looking to pay very little in taxes, then you first must understand how much taxes you could be paying. Okay, so now you know how to calculate your tax situation. Let's go ahead and look at how you can minimize your taxes. So for the vast majority of taxpayers, the rules are straightforward. If you earn a paycheck from an employer, odds are that you have elected to have your taxes withheld, which means you are basically paying taxes that you owe in advance. So every paycheck, your earnings are being reported to the government and some or all of your taxes are being paid. But when you start making investments into business or real estate, then you can optimize your tax situation. Now, the biggest thing that you need to do is to reduce your taxable income. Whoa, Sean, if I reduce my income, then I'm gonna be homeless. Okay, so I'm not saying that you should stop making income, but you need to learn how to reduce your taxable income legally. So remember Bob's tax brackets from earlier? As you can see, he'll pay taxes on all the income that he makes. But actually, thanks to the standard deduction of $12,550 as of 2021, Bob won't pay any taxes until he makes over that standard deduction amount. Which, by the way, that's probably why when you were younger, you didn't make much money and you cared a little bit less about taxes. In fact, you probably enjoy tax time because if you use the standard deduction, you could even see a refund unless your parents claim that refund from you. Anyway, so the standard deduction is a handout that helps reduce your taxable income. Now that sounds pretty good, right? So now, how can you get even more deductions that will help reduce your income? Now there are many ways that you can do this, but in this video, I want to focus on real estate. Buying and owning real estate is an investment strategy that can be both satisfying and bring along tax benefits. Going back to our fictional character, Bob, let's say that Bob has studied real estate and is ready to become an official real estate investor. So his plan is to find a good property and a good tenant who would be willing to live there. So Bob goes out and he finds a single family home that he likes. He gets a loan and then closes on the home. Now, since this isn't Bob's primary residence, it will be treated as an investment property for tax purposes using the Schedule E. On the Schedule E, a whole new world of available tax deductions is available to Bob. He can deduct his advertising expenses that he may use to find tenants. He can deduct his cleaning and maintenance fees for his property. He can deduct utility expenses and much more. However, ideally, he's still making some income from the property, which means his taxable income could potentially be even more, right? While I particularly like these two powerful deductions for real estate. The first one is mortgage interest. So some people, when they take out credit cards, for example, they pay a high interest rate and they can't deduct that interest from their taxable income. But if you are a real estate investor, then you can deduct that interest on any of your mortgage loans. Which means if you have a high enough income, then your loan would be essentially interest-free with the potential of offsetting your taxable income. But wait, there's more. With real estate investing, you can get a bonus deduction of depreciation. That's right, when you own a single family home, there's gonna be some natural wear and tear. The roof, the floors, and other parts will eventually start giving out. That's why the IRS allows you to deduct depreciation of your home, and this alone can be enough to push you into a loss because it doesn't particularly affect your rental profits. Okay, so Bob is actively involved in his real estate investment and reported these hypothetical numbers at the end of the year. Let's say that he bought the property for $300,000. His rental income was $11,000. His mortgage insurance was $1,000. His mortgage interest was $6,000. Property taxes, $4,000. Utilities, $2,500. Depreciation, $7,000. Repairs, let's say he had to fix some stuff up, $7,000, and he reported a rental loss of $16,500. Now let's revisit Bob's tax situation. His tax owed was $18,021 minus the standard deduction of $12,550, leave his taxes owed at $5,471, which he normally would have paid. But since now Bob is a real estate investor, he can take his rental loss of $16,500 and deduct it against his rental income of $11,000, which would reduce his taxable income. And it would leave a $5,500 loss. And Bob can apply that $5,500 loss to his tax owed through a special exception called the passive loss rule, and bang, Bob ends up paying zero in taxes. And the best part is that he now controls an asset worth $300,000. So if everything hypothetically stayed the same for the use of the loan, Bob would own a $300,000 home without having to earn more money or pay more taxes. Now, instead of Bob paying taxes of $18,021, he paid zero. And he was able to make an investment into an asset that will increase his overall net worth. So that's the way to do it. Now, obviously, this is a simplified way to minimize your taxes, which works great if you make an income of $100,000 or less. But as your income increases, you have to be willing to take more investments into real estate or business or something similar to minimize your tax liabilities. And wow, look at that. You made it to the end of this video. So you might as well go ahead and give us a like. It will help other people like you also find this video. And if you want more great information like this, go ahead and subscribe so we can stay connected. All right, guys, well, that's it for now. Thank you so much for watching. I'm Sean, and I'll see you in my next video. Peace.